Royce, Dhruv. Here we are. It's mid-August. The market is seemingly pretty benign right now. The S&P 500 is up right at 10% for the year. And if you weren't around in April, you wouldn't have noticed any volatility almost at all, despite a pretty active news cycle backdrop over the last 9 months, obviously, given the election, huge news around tariffs and all that. So what's happening with equities? Do stocks just want to go up and the news doesn't matter? Or what's the thought there?
I'll let the equity guy talk.
You're right. I mean, it's been an interesting environment. I think we had that quick sell-off, 15% in the S&P 500. If you look at a sort of 20-year average of stocks, we're right back to trend line or even higher. I think, the market has been thinking a lot about artificial intelligence. That continues to be the driver. There's hope there, and I think a well-founded hope that there will be a productivity boom that is a result of this new technology sort of infiltrating our economy, not just in the U.S., but globally. Thinking back to the internet days of the 90s and seeing what that did for productivity and for our economy and for stocks, certainly we ended that point at a, maybe an overvalued level, but it really did drive growth in our economy for years to come. And so I think there's a belief that AI has the potential to do that, and that seems to be the driver. There's a lot going on under the surface with equities as well, and not everybody's participating. I think that's one thing we've focused on, but that's, in my mind, the primary driver of equities doing better.
And also, inflation hasn't gone crazy like people think it would have. GDP growth is sort of okay. It's not terrible, but it's not great. But it's been where it's been in the past. And then there's the specter of interest rates coming down, which also support markets. So, I think we've all learned in our careers that markets act a certain way till they don't. And so you have volatility in the markets or lack of volatility in the markets, and 10 days later, everything changes, and then you don't know. Then you say, well, you can point to all the reasons that you just said, Chris, where there's sort of news flow, there's tariffs, there's debt, there's deficits. Or why did the markets go up before that? Then people start to question the actual rise and the lack of volatility. So markets are such a behavioral sort of animal that in terms of what it really does is you can rationalize after the fact. But I think just being aware of these things in the background is kind of really sort of important. So there will be a productivity boom of some sort. I think it's real, but you cannot raise every single equities price because there's going to be more competition, and ultimately equity prices get competed away because this is a capitalistic society. So if you can do more and your competitors doing more, they'll compete with each other. The prices will fall, the consumer will benefit, which is what happened with the internet. But then the equities kind of mean revert back down. So that's what the markets think, but who knows?
Yeah, it makes sense. It's funny, you think about a company like Amazon, which was the poster child of the late 90s, and not an internet company at all. I mean, turned into an infrastructure and logistics business that now probably Amazon and Walmart are the two behemoths in the logistics world, and Amazon was trading because it was selling books over the internet back then. So it turned out to be a great business, but that was because the founder could kind of see around the corner. Not the market certainly did not.
Yeah.
What you mentioned. Inflation, just briefly. So where do you think things go from here? And then maybe weave in a little bit of how AI affects that. I mean, we're certainly hearing rumblings of less hiring in certain areas over the next couple of years as companies start to digest what can we do with AI. And that's usually not, that doesn't begin with laying people off. It just begins with not making that next hire and trying to get a little more productivity out of what they have already. I mean, are we going to see a lot more of that?
Yeah, it feels like that. And I know Royce has done a lot of work on looking at AI. I would just say there's a saying that I guess those that have those that have knowledge don't predict, those that predict don't have knowledge. So I'm not going to predict on inflation, except that to say people have been concerned about inflation since 2010, right? They've been talking about inflation coming and the money printing. Yeah. I do think there's a breaking point more because of the debt and the deficit, because it's unfinanceable at some point in time. But even if tariffs do create an inflationary impact, it really is truly a one-time impact and one-time set, unless it gets embedded in the psyche of the economy that rates are going to get, higher and higher. I don't see that as being a super high, issue from at least the tariffs themselves.
I agree with that, and the numbers really prove that out. Part of the reason the market sold off back in March and April was a fear of recession and other things, and just uncertainty. We've never gone from 2.5% tariffs to 20% tariffs, so that was a little scary. The fact is the inflation numbers have really not been impacted by the tariffs yet. Now, maybe they will be into the next few months and quarters, but inflation has been higher. We ran at 1.5%, 2% for 20 years. The Fed target's at 2%. We ran up to 9% in 2021. We're down to about 3%. So it's stubbornly high here. There are some inflationary factors out there that aren't going away. Sort of this deglobalization, reshoring, tariffs certainly play a role there. Labor is becoming a little hard to come by, and there's various reasons for that. But the reality is the tariffs thus far have not shown up in the CPI. We just saw a number yesterday. CPI ticked higher, but it was all domestic. It was rents, for example. Imported goods actually declined, believe it or not. So, the best case scenario for Americans is that the foreign manufacturers absorb the brunt of that. So far, it looks like that's the case. Ultimately, there's three sort of parties that have to pay that tax. It's the foreign manufacturer, it's the U.S. importer, and it's the consumer. It comes through in lower profit margins for the foreign manufacturers and for the U.S. importers, or it comes through higher prices. And so far, it appears, again, there was a study I just read yesterday that said, so far we're really not seeing that. We don't see inflation going back to where it was in 2021. That was a rare thing and sort of a confluence of factors that probably won't be, we hope, repeated. But you do need to pay attention to that, and certainly as we build portfolios, we want to think about investments and allocations that can do well through an inflationary or higher inflationary period, even if that's 3% versus 2%. Certain companies, for example, are able to pass through costs a little easier. Commodity-oriented businesses tend to do well, et cetera. So it's always a factor, but I think it's a fear for clients. Again, inflation eats away at your spending, and so it's something we need to always be aware of and factor in.
And I think you made a really good point, which is, inflation's not going to go back to 1 or 2%. But if it stays at 3% or 3.5%, that's not the worst thing in the world just for the stability of the economy, because you can kind of start to grow out of your debt, some of those issues. I think it's a little bit of pain, but it's spread out over 20, 30 years. You just have to invest smart so your principal doesn't get depleted through inflation. So, and then Chris, you were talking about AI, I think you mentioned as well, but it almost feels like there's a bifurcation in the economy. And with AI, it's the knowledge workers that may get more impacted. That's where the productivity increases will happen. That's where maybe wages stop growing as much. That's an offset to the tariffs. But for the real stuff, it may be the gas you put in your tank. It may be like building a house and the building materials. Those will get impacted by tariffs in some way, shape, or form, because there's a shortage of some of these sort of materials as well. So it's almost, I think looking at CPI as a whole number in inflation does a disservice to the analysis, because you can really think of it and compartmentalize into two different parts.
Makes sense. Let's talk about rates for a second. If we look at private investment asset classes like private equity and real estate, it's probably about the only place we're seeing a lot of actual distress at the moment is certain assets that were over-levered with floating rate debt when rates were low. You turn around 18 months later and they're over-levered with floating rate debt that now has double the interest rate. And it's been a problem. But it also leaks over to consumers. You mentioned housing. We have a lot of young people that have a very difficult time affording to go buy a house with 7% mortgage rates, versus where they had been at 3%. So what do we think about rates in the short term? From an investment perspective, obviously there's some interesting things happening from, good business, bad balance sheet type situations that we can take advantage of. But is there a clear thought on what's going on?
On interest rates.
Sure. Or you can take that either way.
Take that either way. Well, I think the biggest impact, we are a financialized society, so the level of interest rate matters on almost everything we do, right? It's embedded so deeply into every person's either home ownership or apartment they're paying rent on because someone else owns it and pays interest on. So I do think it will take some pressure off if interest rates do decline. The housing market as a whole and the affordability crisis, I think it's probably going to stay this way. I don't see really real estate crashing, at least from a housing perspective. It just slowly keeps getting less affordable, more affordable as interest rates potentially decline. But all of these assets have been priced at 3% mortgage rates because they are point dependent. They're path dependent, not just point dependent. So you have to go back to 3% to get to that level of affordability, which is probably not going to happen. So you just have to grow into it.
Yeah, I think from an investor perspective, if you think about interest rates, it was 5 years ago, I think this month or next month, that the 10-year Treasury hit 52 basis points. That was the yield. You loan the government money, they pay you 0.5% for the next 10 years, and you're supposed to be happy with that. So it was a weird time. We were in a period of artificially low interest rates. When inflation moved up dramatically, the Fed had to respond. The Fed raised rates. Rates are now what we would describe as normal, whatever normal is. But as an investor, that's great. We weren't going to lend our money out to anybody at 50 basis points 5 years ago. Today, you're looking at, maybe it's 5%, something like that.
Yeah, you can 6%. Make 5 to 7, even 7% in some safe type of...
In safe type investments. Yeah. So that's a real positive. So there are good positive rates of return. Obviously, inflation is important there because it's a fixed income. And if inflation rises higher to that, the coupon you're receiving, that can sort of minimize your after inflation return. But so in general, I think that's good. The conflict, though, is that credit is as expensive as it's ever been. And so if you're loaning your money to a corporation and buying a corporate bond, you're getting paid that treasury yield plus some premium to take the risk to loan your money out to whoever it is, Procter & Gamble or some company. But that margin is as skinny as it's ever been. So you're really not getting paid much right now to take that risk. Now, some of these companies you say, well, Procter & Gamble isn't going to default. Don't worry about it. No big deal. But you move out on the risk curve, into high yield, into bank loans, into private credit, and those yield pickups, those spreads are also as small as they've ever been. And so, the question is, it's sort of priced to perfection. And so far, things look good. Again, the likelihood of a recession we think is very low. We've got tons of fiscal spending, unemployment's low, all the things that we've talked about. AI is hopefully producing some productivity gains. But, a moment may come and narratives change, as Dhruv said, and it's possible you could see those spreads widen out and investors would, for example, just demand, I need a little more yield if I'm going to loan my money to this borrower. And so that's a little bit of a risk. Again, we're at a normalized level, so you can feel good about getting paid, kind of a base rate, but the risk is pretty expensive.
Yeah, from an investment perspective too, the one area we've been looking at, and there may be some value, is, if you look at commercial real estate, especially office, a lot of those loans were taken out at low interest rates. The regional banks that made those loans don't want to show the losses on their books. So they've been rolling those loans with some pay in kind, instead of cash. And so from that perspective, you're starting to see some distress as some of these loans are reset to higher rates. And so we've been active in that space to be able to take opportunities, like Chris said, good business, bad balance sheet. So some of those could be good assets and investments. But keeping an eye out for that as a risk, I think is kind of important. They will get some relief if interest rates come down, though.
Makes sense. Yeah, to your point, we were just talking with a real estate operator that we're invested in that bought a loan from a bank at what was effectively 25 cents on the dollar to the basis of the original building, and then are foreclosing on the loan. Right. And so, the original investors, this is an office building in Atlanta, kind of Class B office building, but obviously taking a pretty big haircut. The original equity is zeroed out on that. And that doesn't mean it's a great deal, even in buying something at 25 cents on the dollar of what the original basis was, depending on what you own. But it does seem like there's starting to be some cracks like that. But to your point, Royce, not in the broader market. Spreads are still tight. Equity valuations are high. So the question is there going to be a catalyst, and when? And that's the $1 trillion question that none of us know the answer to is right. what potentially breaks things and what opportunities are going to show up.
Because we have wisdom and we don't like to predict, right?
That's right. Yeah, that's right. We're too wise to try to predict that. Well, thanks very much. Appreciate you guys, your thoughts on everything.